Good afternoon and welcome to today's program that will cover indirect rates and an overview of what strategies are right for your organization. Today's presentation is brought to you by the Pacific Northwest Defense Coalition and Uninet. First, I want to confirm that everybody can hear us okay. If you could please type yes in the question field and confirm that you can see the screen and hear the audio okay. Great. Thank you so much. Please feel free to use this same field to ask a question at any time during the program. Just type your question in the webinar dashboard and we'll share it with our speaker. Please also see the handout tab on the webinar dashboard. Under that, you'll see a copy of today's presentation, some relevant white papers, as well as a list of upcoming PNDC events. We are very pleased to have Rich Wilkinson, Director of Solutions Engineering at Uninet, joining us today. Rich has spent more than 8 years as a contracting officer with the Naval Air Systems Command, then 10 years at a variety of financial and accounting leadership positions at leading government contracting firms, from Mantech to General Physics to CSC. In those 10 years, he has implemented accounting systems in 12 different business units of those companies and managed both financial operations and government contracting compliance functions. Thank you, Rich, so much for joining us today. I appreciate you sharing your expertise. Please begin the presentation.
Thank you and welcome, everyone. As we go through the presentation today on indirect rates, we'll be talking a little bit about basics. I always feel the need somehow to go back and review some of those basics. And it never fails. I always get a few people that tell me later, you know, I never knew that about one point or another. And then we'll talk a little bit about some of the traditional rate structures, why they've evolved the way they have and why people use them. And then if we have time, and I think we will, we'll dig into a couple advanced structures and talk a little bit about where those can be useful. Then I'll touch on developing rates and then the ultimate endpoint for any rate, the incurred cost proposal audit and the final rate negotiations. And we'll wrap up by talking about a few trends in the whole rate environment and a few issues around those trends. Let's get started. Any indirect rates presentation has to start with the types of rates, and there are only two primary types at least. They're direct costs. DCAA and the FAR, the cost principles, consider direct cost those that are attributable to a single contract or a job or a small group of jobs where the cost can be divided up among those jobs directly, where those costs are caused only by that job or they benefit only that job. Indirect costs are those that really can't be associated solely with one job or one contract, and they need to be pooled and then allocated from that pool across multiple jobs. That basic concept is the core of all job cost accounting, and it's the core of what we'll talk about today. The rate itself is simply a fraction. The numerator of that rate consists of the cost pool, the indirect costs that are going to be allocated to the jobs that are part of the allocation base. And that's the denominator of the fraction. The denominator consists of the related direct and sometimes indirect costs that are going to be used as the allocation base. I've got a couple examples in the little box at the bottom of the slide there. If you have fringe benefit costs, for example, of $280,000, but you have labor cost of $1 million, then that's a 28% fringe rate. What that says is for every dollar of labor that goes out in a paycheck or a payroll, I have 28% or 28 cents of fringe benefit costs that are going to end up in my fringe benefit pool. And in order to recover those costs, I need to allocate them out to the same jobs where the labor was charged. By the same token, if I have an overhead pool with 400,000 of overhead cost in it, and then I have direct labor of 800,000, that's a 50% rate. 400 over 800, it's a simple fraction. And again, for every dollar of labor that I incur or charge to a job, I need to charge another 50 cents to the same job to get back my overhead costs. Sounds simple as a concept. Actually, in operation, it trips us up sometimes. The key to what goes in which pool is something called a causal beneficial relationship. The indirect costs sitting in the pool that need to be allocated should have that causal beneficial relationship to the allocation-based costs. Sometimes that relationship is really clear, it's just common sense. Fringe benefit costs are almost always allocated over a base of labor because labor, people, cause fringe benefits. If I didn't have those pesky people, those employees, I wouldn't have those fringe benefit expenses. Sometimes the relationship's not quite as clear. It's a little more esoteric. Facility costs, for example. Facility costs could be allocated over a number of different bases. I know companies that use square footage, for example. So for every square foot of space that an organization occupies, they get an allocation of so much per square foot of facility cost, and sometimes called occupancy cost. And those costs are the heat, the lights, the water, the rent, the depreciation of the furniture and fixtures, everything it takes to house employees and give them a place to work and provide them the tools. Sometimes it also includes their computers, the IT cost, things like that. Sometimes the relationship between the cost in the pool and the cost in the allocation base is actually dictated by the regulations. More on this later, but one example of that is the general and administrative pool. The GNA pool consists of what in the accounting world are called period cost. They occur in the current period, but they may or may not be related to activities in the current period. A good example would be, let's see, strategic planning. I'm going to incur the cost of strategic planning, whether it's the planning group or the CEO, the CFO, those kinds of people that do that kind of planning work, but the plans are for next year and the year after that, and perhaps the year after that. Another example is bid and proposal cost. I incur those bid and proposal costs this year. They're allocated on the same base as my GNA. Most people simply consider them to be GNA, though that's not exactly right. But if I win the job, the cost of the job will probably be next year and the year after that, and maybe several years after those. So those costs are a little different. So the regulation specifies the acceptable allocation bases for those kinds of costs. Let's take some specific examples. And the process that we're going to go through here is what I call a pool purification process. And I've been through this process with a number of clients over the years. And it's usually a result of DCAA coming in and doing either a rate examination for prospective rates like provisional billing rates, or perhaps even an incurred cost proposal. They're auditing the incurred cost from a past year. And they look at the cost in the pool and they say, wait a minute, that cost doesn't belong in that pool. That belongs in this other pool. They'll look at an overhead account, or what we consider to be an account in the overhead pool, and perhaps say, well, that belongs in the fringe pool. In some cases, that's a judgment call, but those judgments are easier if you follow a few rules of thumb. And here they are. Here's the one for the fringe pool. Fringe benefit costs are allocated over usually a base of labor because labor causes the cost. So what I've done many times with my clients is simply go take the pool cost in the fringe benefit pool and go through them account by account. And for each account, stop and say, okay, what causes this cost? Is this cost, does it arise directly from the employment relationship? Or is there some other function or activity that's causing this cost? So when I look at something like payroll taxes, crystal clear. That arises directly out of the employment relationship. If I didn't have those pesky old employees, I wouldn't have employment taxes, payroll taxes. Paid absence, same thing. When I look at the paid absence costs, that's caused directly by having employees and giving them time off. So that causal beneficial relationship, particularly when you look at it account by account, is pretty clear. I got to one of those with a client, and I think the account in question was trying to remember. I think it was something like dues and subscriptions. And I said, are these dues paid on behalf of the employee to the organizations they belong to? And that was probably the original intent of that account, but the controller said, no, these are dues for organizations that the company belongs to. I said, well, what causes that relationship? What caused the cost? And the answer was, well, the cost was caused by the company belonging to that organization. So that didn't arise out of the employment relationship. And we decided to move that cost and put it in the GNA pool. So that's the process. We stepped through it piece by piece. So here's the rule of thumb. In general, cost in the fringe pool should arise, and I'll put the word solely in there, solely out of the employment relationship and not from any business activities and not from business outcomes. So now look at the overhead cost. Pooled overhead costs are usually also allocated over a base of direct and B&P labor. Sometimes other kinds of labor, like labor in service centers, for example, that are going to then be allocated out somewhere else. The labor in that allocation base causes and benefits from the overhead pool cost. Costs like supervision, training cost, support cost, like those dues and subscriptions things, if they were paid on behalf of the employee. Costs like indirect travel for supervisors to travel to job sites, perhaps, or visit customers. Often IT cost. Another set of costs that I often see in the overhead pool are things like incentive and morale cost. And I often get into discussions with clients about, well, shouldn't that be in the fringe benefits area? And I put it to them this way: if that incentive, if those morale costs are shared equally by all the employees in the company, just because they're an employee, then yeah, we should put it in the fringe pool. But if that incentive is performance-based, if it's paid for a business outcome, it should be related to the projects that are being measured to determine that outcome, namely the overhead pool. So the rule of thumb there is, in general, cost in the overhead pool should arise out of work done on projects for customers, whether billable cost or B&P, which just simply has an internal customer. We often see overhead costs split between two different pools. In fact, I have some clients that have a dozen overhead pools, but most commonly I see two pools based on where the laborers worked. Labor worked on a company site or in a company facility where, frankly, I have to house them. They get heat and lights and water, and I pay the rent for them, and they get a desk to work at and a computer and IT support and so forth. But there's also labor worked on host sites, perhaps a government site, perhaps a prime contractor hosted site, where I don't furnish their workplace. I don't furnish the furniture or the heats and the lights and the water. All that's done by a host. It's not my cost. Often in a situation like that, we'll separate the allocation base into company site labor and host site labor, and we'll allocate the two pools separately to the different kinds of labor. The cost in those overhead pools are often identical, except for that occupancy cost. So perhaps the two pools get the same amount of supervision, training, support, or IT. The incentives are the same, morale costs are similar, but the facility costs only occur in the company site pool and not in the host site pool. That's the infamous on-site, off-site. And you'll notice I did not use that terminology. And the reason is that the government uses it both ways. So the government will say on-site, this is your on-site labor. They mean on their site, not yours. And of course, we'll sometimes use it the other way. So I use company site and host site. Helps keep it straight, at least in my head. Finally, let's talk about the GNA pool. The GNA costs are those associated with running the company, not doing work for clients, not supporting employees with benefits and so forth, but the strategic planning cost, the operational cost of running the company, the executive management of the organization itself. So that's where we find executive labor, the fringe associated with it, their facilities cost to house them. The finance and accounting function is almost always in the GNA pool and their associated cost. It's also where we find things like business licenses, state, could be state income taxes, could be state, what do they call it? Revenue, certain kinds of revenue taxes at the state level. The allocation base for GNA is one of those that falls into the category of dictated by the regulation. And the larger you get, the more likely it is the government is going to tell you what your allocation base for GNA is going to be. There are really only three. Now, we settled on labor for fringe and overhead, but the reality is I've seen that done a number of different ways. I've seen head count for an allocation base for overhead. I've seen labor hours as an allocation base for overhead. We used cost because it's easy. For GNA, it's always cost. It's called a cost input base, no matter which one of the three is used. The only difference is what is the cost that makes up the input. In the case of total cost input, it's very simple. Everything that isn't GNA is in the GNA base, with a few exceptions. This is government contracting. Everything has an exception. The exceptions here are usually things like statutory unallowables. Federal income tax, for example, isn't in the GNA base because it's never allowable. It's never anywhere. It's what we call in the finance world a below the line cost. So after I've done the accounting for everything else, then the federal income taxes come off of that. Other kinds of costs that are unallowable are also not part of the GNA base, like interest expense or cost of borrowing or cost of entertainment. It's never allowable. It's not part of the GNA base because it's not part of anything that would ever be allowable. The value added GNA base is also a cost input base, but it's not total cost input. It's total cost minus materials and subcontracts. And I've seen this one done improperly about every way it can be. I've seen companies exclude materials but not subcontracts, or subcontracts but not materials. And DCAA and other regulatory organizations never go along with that. They don't even have the latitude to go along with it if they wanted to. The fact is you must exclude both or neither. If you exclude neither one, you're on a total cost input basis. If you exclude them both, that's the value added GNA base. We'll talk a little bit more about that value added base and why that's a trend these days in a little while. The last one is single element, and single element is used primarily by consultants or really small companies where the only product of the company, the only service provided is labor. And that's almost always the single element. This is used by firms like law firms, PR firms, accounting firms. Most CPA firms use single element. And there's a sneaky little reason for that. It's actually pretty smart. If you use single element, then all of the indirect expenses, fringe, overhead, GNA, everything is loaded onto one element of cost, namely labor. So you have direct cost, which are labor. You have indirect cost, which is everything else except for travel. So travel and the little incidental things that show up on personal employee expense reports, those aren't part of the base. And so they're never part of any kind of rate that requires negotiation or a proposal submission or an audit. Remember how these consultancies, CPA firms, PR firms, remember how they normally do business. It's on a time and materials basis. So they're building up a time and materials hourly rate with just labor plus that total pool on the single element of labor. And when they bill things like expense reports for travel, there is no burden applied to those. And so there's nothing in that T&M bill that ever has to be redetermined or audited to establish a final rate. Therefore, if they have an IDIQ with delivery orders, they can close out those delivery orders as soon as the performance is done and the last bill is submitted. They don't have to wait for their GNA to be audited 2, 3, 4 years from now before they can close out a delivery order. Smart, and it works for them. But for a lot of us, it doesn't work for a number of reasons, usually because we have a material amount of subcontracts or material or both. Let's review those rules of thumb just quickly. You have fringe costs, and those usually arise solely out of the employment relationship. You have overhead costs, and those arise out of and provide support to the work performed on behalf of your customers. Could be an external customer for billable work or an internal customer in the case of B&P. GNA costs arise out of the activities associated solely with running the business as a whole, not a division, not a project, but the whole business. And it includes the cost of winning new business, like business development and bid and proposal cost. DCAA refers to these three kinds of cost as a three-tier rate structure, and you'll hear them use that term. You have a three-tier rate structure, and we know they're talking about fringe, overhead, and GNA, but this is where the terminology comes from. And then they use that causal beneficial relationship, sometimes like a hammer, to describe the association between the pool cost and the allocation basis. Let's talk a little bit about the traditional structures, because even within that three-tier structure, there are different ways of doing things. First of all, there's that single pool, single element. We just talked about that. About 1% of all government contractors use a single element or single pool structure. It's just one rate. It's dead simple. It's easy to calculate, easy to track, and rarely used by companies of more than a few employees, except for the pure consultancy companies. Sorry. Then there's the two-tier structure. And this one sounds like it might be different or complicated. It's not. I apologize for that, and I fix it in real time. The single pool for overhead and GNA combined and a separate pool for GNA gives you two pools or two tiers. Auditors don't like it very much. Contracting officers don't tend to like it very much either. They don't see it very often, and so they don't understand it. It also doesn't work if you have on-site, off-site, or company site, host site splits with two different overhead pools. That makes it much, much harder. Then you have to have an intermediate pool for your fringe and allocate the fringe into the two overhead pools. It's frankly just easier to have separate fringe and overhead pools if that's the case. But if you don't, if you have one fringe, one overhead, another way to think about that two-tier structure is if you have a fringe with a base of labor and an overhead also with a base of labor. Since the two bases are identical, you can just add the two rates together. So if you have a fringe of 28%, like in my earlier example, and an overhead of 50%, I can just add those two together. That makes 78%. I can just call it 78% and use it as a single rate, and the math works fine. I don't have to do anything else, don't have to do anything special. Some companies just combine all the cost in one pool rather than maintaining two pools and adding them together. Almost everybody else, now let me add it up. I had 1% that used single element and about 5% that used a two-tier structure. So that leaves about 94% that probably have a three-tier structure. They have a pool for their fringe, usually with a base of labor. They have a pool for overhead, also with a base of labor. You will occasionally see overhead with a base of labor plus fringe. And we'll touch on that a few minutes from now when we talk about trends. That can be problematic if you have multiple fringes. Now, I'll tell you why a little later. It's mostly done for optics. The rate looks lower. If I have a base of labor, my overhead is, in the example I used earlier, was 50%. If I put if I put fringe in my overhead base, so if my overhead base is fringe plus labor, then that 50% would be about 42%, something like that. It looks lower. The math is the same. This is a zero-sum game that we play with rates. It's like punching a pillow. You punch it in over here and it pops out over there. So it doesn't actually do anything to put fringe in the overhead base, but it does result in a lower appearance for the overhead rate. The pool for GNA usually has a base of either total cost input or value added. This three-tier structure is popular with the auditors and most contracting officers. They see it all the time. They understand it. It's taught in the schools that they go to and the courses that they go to. It's taught in the pricing courses. When I was a Navy contracting officer, they taught this three-tier structure in every pricing course I went to. They would talk about single element and two-tier structures for about 5 minutes on day one, and the rest of the week they would talk about the three-tier structure. So it's kind of understandable that folks don't understand the other structures as well. They just don't get very much discussion. So now we're at our first poll. I'd like to get a little information from you in the audience. Tell me what your pool structure is at your company. Do you have a single pool with a single element? Do you have a two-tier with a pool structure with a combined fringe and overhead and a single GNA? Do you have a three-tier structure with fringe, overhead, and GNA? And I got two more choices here. Do you have a three-tier structure with multiple fringes and multiple overheads, either or? Or do you have something yet different from any of these, the other category? We'll give you a minute or two to pick one, respond to the poll, and then I'll ask Kate to show us what the results are. How about it, Kate? What's it look like?
Rich, it looks like we have a few different answers here. 30% with a two-tier structure, 50% with a three-tier structure, and 10% with a three-tier structure with multiple FRs and OHs, and then 10% in the other category.
Wow, now that's interesting. I can count on one hand. Shoot, I can count on one finger the number of times I've gotten that interesting spread of results across those 5 categories. This is a group I'd like to spend more time with. Let's go on and talk about some more advanced structures. I'm going to make it a little bit complicated here. And this might be something that some of these folks that picked number 5, the other category, might have. This comes from a experience I had about, I'm not going to say how many years ago. It was several years back with a company where I was the controller. And this company had divisional overheads with the fringes embedded in the overhead pools. Problem was they had 32 divisions. So they had 32 separate overheads, each with its own fringe. And some of those divisions were really small. Now, everybody knows what happens when a pool and its allocation base is really small. That rate gets really volatile. It doesn't take very much to shift that rate dramatically up or down. So the company said, give us something that's flexible enough that we can use it to win work. We can recover all of our cost, but it's not 32 different rates. We'd like to have, a dozen or so. So here's what we did. So the why question, we needed flexibility. We needed to be able to win work from low cost to some very sophisticated work with expensive people and everything in between. So here's what we did. First, I have to talk for just a second. We'll take a short detour and we'll talk about a wrap rate. A wrap rate is just shorthand for how much do I have to sell a dollar's worth of labor for to break even. So if I have a fringe of 28% and an overhead of 50 and a GNA rate of 15, then I take that dollar's worth of labor and I add 28 cents for the fringe and 50 cents for the overhead, and I take a subtotal, and then I add 15% on top of the whole thing to get my GNA back, and I get a result of $2.05. So I have a wrap rate of 2.05. That means every dollar's worth of labor I sell will cost $2.05, assuming, of course, that I want to break even. I haven't put any profit in there yet. And that's kind of middle of the road. Actually, in some environments today, that would be considered a little bit high. But, as my boss used to say, it is what it is. If that's what it costs, that's what it costs. The only way to make that lower is to cut cost. I can't do it with structures. I can't do it with creative accounting. By the way, do you know what you call a creative accountant? Inmate. Okay, so let's take a look at what we did at this particular company. We developed 3 different fringe rates. We had a full fringe rate, and this is what we incurred for the typical employee, especially the guys that were hard to recruit, the former naval officers coming off of submarines with nuclear reactor experience. They wanted benefits. They usually didn't stay to retirement, so they didn't have a pension. They didn't have military medical benefits. They needed the full boat. So their fringe rate came out to about 36%. And that was pretty common in those days, still pretty common. Then we had a group of people that were more senior military people, typically, not always, but some of them. They were retired. They had perhaps a partial pension or even a full pension. They had perhaps military medical benefits. They didn't need all of our fringes. And so when we hired them, they accepted a reduced fringe benefit package, and that reduced benefit package resulted in a lower rate. And then we had some people, typically these were what we call our part-time or on-call people, and their fringes were just statutory minimums. They were the required payroll taxes, maybe an AD&D policy, that's accidental death and dismemberment, maybe long-term disability, things like that. But that added up to only about 14%. Then we went a step beyond the typical company site, host site, because we had facilities in some very expensive places like downtown San Francisco and New York City, even downtown Washington, D.C. And those are very expensive places to maintain facilities. So our facility costs were rather high. But we also had offices in what we called field locations, places like Kings Bay, Georgia, and Bremerton, Washington, and Fort Rucker, Alabama, and Killeen, Texas, and places like that. And those occupancy costs in those places were rather lower, in fact, a lot lower. So we had about a 55% overhead rate in places like that. And then we had people that worked on a host site. They went to work on a military base or in a nuclear power plant. We didn't provide any of their day-to-day support, furniture, fixtures, space, or anything else. And their overhead rate was around 12%. And it wouldn't have even been that high, except especially for our nuclear power plant people, we had a significant amount of training and recertification cost every year. And that bumped it up a little bit. So for each cell in this 3x3 table, we take $1 worth of labor, add fringe. In the case of that upper left-hand corner, we had 36% fringe and 90% overhead, and then layer 15% GNA on top of that. And I get a wrap rate of 2.6. So for every $1 worth of labor, I need to sell that for $2.60. At the lower right-hand corner, if I take a 14% fringe rate and a 12% host site overhead, and even layering a 15% GNA on top of that, I can break even at $1.45 for $1 worth of labor. That's pretty low. And we could win with that almost anywhere. In fact, we won a couple big contracts at a place called Fort Huachuca, Arizona. On a host site, lots of people. It's a fairly low cost of living area. The salaries we paid were already low, and the overhead and GNA, the overhead and fringe were low. 1.45 is a pretty low wrap rate. But remember, there's no profit in here yet. So let's assume a 10% profit rate. So now, assuming a 10% profit rate, I take each one of these cost per hour and bump it, or cost for $1 worth of labor, and bump it up by 10% for profit. So now $1 worth of labor in a major metropolitan area, if it's a full fringe person, I have to sell that $1 worth of labor for $2.86. On a host site in the middle of nowhere, usually, I can sell that $1 worth of labor for somebody with a minimum fringe package for $1.59. But look at the rest of the table. 286, if I drop down 268, 258, 242, 224, 214, $1.87, $1.70, $1.59. With the right combination of location and the kind of person and the fringe rate we paid them, we could get almost any wrap rate you could possibly need. And that's what always happened. The BD guy would come flying into my office and say, I have to have a wrap rate of 2.1. Okay, well, let's take some field office people with a minimum fringe and some host site people with full fringe. That'll 214 and $1.87. I can get you down below 2.1. And we would bid that job that way and work it that way if we want it, because that's the way that kind of stuff works. And this worked extremely well for this company for a number of years. I've been tracking them even since I left. I've been through several companies since then, and they still have this same structure because it works for them. They're up to around 1,200 people now. So here's our second poll. What's your wrap rate? What's your primary wrap rate? Because just like that company I was talking about a minute ago, you probably have several, but what's the one you sell the most? Is it more than 2.5? Is it between 2 and 2.5? or somewhere between 1.5 and 2? Or have you gotten down below 1.5? By the way, that's really hard to do because that 1.5 is basically payroll taxes and not much else in the way of support and a little bit of GNA. So we'll take a minute or two and let you respond to that poll. I wonder if this one's going to have the kind of interesting spread that we got in our first poll.
Great. We'll give everybody 10 more seconds here to put in your answers.
I would hum the theme from Jeopardy, but I usually get requests to stop when I do that.
Perfect. I will go ahead and close the poll now.
So what's it say, Kate?
Great. Can you all see the results on the screen there?
No.
Looks like between 2 and 2.5 is 75%. Between 1.5 and 2 is 25%. None in the other categories.
No outliers. Oh, folks, you have disappointed me because that is so ordinary and so typical. After the first poll, I thought sure we were going to get some really interesting spread on this one, but 1.5 to 2.5 is right where almost everybody is right now. And there's a reason for that. I'll talk about that in just a minute. Let's talk a little bit about developing rates. And I'm not going to spend too much time here. We'll sort of skim these slides. By the way, the slides will be available to everybody after the presentation. Kate will tell you at the end how to go about getting those slides. First step in developing rates or a rate structure is pick one. Any structure will work. I get the question all the time, what is the right rate structure for me? Which one is the best one? Well, the right rate structure is one that the people who audit you are comfortable with, your contracting officer understands, and which will allow you to recover all your costs. And finally, you have to be able to win with it, because the best rate structure in the world that doesn't win any contracts is no good. Your BD people will tell you that in a heartbeat. So a little bit of common sense advice, stay mainstream to the extent you can. Unless there's a really good reason not to, don't unnecessarily complicate things. Second piece of advice, keep your pools as large as feasible. If you have the choice between 6 pools and 2, and the results aren't significantly different, go with 2. Because 6 pools, some of them are going to be small, and small pools are volatile. You expose yourself to dramatic swings in the rates. And then finally, pick a pool with enough structure or enough flexibility that it's going to work for you for several years, because you do not want to have to change your pools every single year. That's just more work than the law ought to allow. Second step, you estimate your indirect cost by cost element, and by cost element I mean general ledger account for the accountants, and by pool. And it really helps to take that chart of accounts, take your cost elements, and go through that purification process we talked about very early on. Go through and ask yourself for each and every account, what causes this? Is this caused by employees? Is it caused by customers? Or is it caused by the business? And that'll tell you which tier it goes in. And after that, which pool it goes in is usually an organizational issue. There are lots of people out there that are willing to give you advice on what goes in what pools. Pick and choose carefully. DCAA's advice is probably the most generic of the bunch, and they don't have an axe to grind really with respect to where you put things. DCAA has on their website, that's dcaa.mil. Don't go to dcaa.com or .net or .org. Those are not DCAA. DCAA is the Defense Contract Audit Agency. It's a military organization, And so their website is dcaa.mil. Right on the front of their website, there's a link there to something called Information for Contractors. It's about a 25 page document. It used to be a really nice book. Now it's basically a letter with a 25 page PDF attachment, but it has really good information in it, including a pro forma rate pool structure that's actually pretty good. You can take that pool structure and do some variations on it, split the overhead pool in two pieces, have multiple fringes and that sort of thing. But the basic assignment of cost elements to pools is pretty good. You'll also find the same kind of pro forma spreadsheets or structural recommendations at places like the National Institutes of Health, the Centers for Medicare and Medicaid Services, NASA, places like that. But, and this is a little, just a tiny bit of a caution, these guys are interested in you doing things their way, and they have a particular way of doing things because their business is unique. NIH is healthcare. CMS is medical support costs. NASA is astronautics. And so they do things a particular way. And if you use, for example, NIH's recommended pool structure and layouts and assignments of elements to pools, you might find DCAA doesn't like it very much. DCAA's, I think, is the best one simply because it's the most generic. But if you're a contractor that has business primarily with NASA, shoot, use their layout, use their recommendation. So here's some common sense advice. Again, stick with the recommended elements in the pools that your customer promulgates in their template. Get help for the first time you do it. And remember, an estimate based on your experience or your judgment is better than leaving something out. So if you think a cost needs to be there, but you don't know how much, take a common sense guess and put a number in there, because your judgment is better than not putting something in, especially when it comes to a cost that's going to pop up later. Then do an estimate of your direct cost by job. Boy, the BD guys hate this one. The business development people usually do this on an annual basis. They ought to be doing it on a 2-year rolling forecast, at least every quarter. When I say that, they just shudder. It's a lot of work, but you have to have these things to figure out what the allocation base is. Remember, rates are a fraction. It's pool over base. You can do the estimate of the pool, but somebody's going to have to tell you what the base is going to be. And that's where this comes from. It's the current work, it's the future work from current customers, and it's what the BD guys call blue sky. It's the stuff we don't know about yet, but we know there's going to be some. That's the hardest one to estimate. So, common sense advice, estimate your jobs in enough detail to be able to see the elements, but not so much detail that it never gets done. Because if it's too complicated and too sophisticated, the process will break down. With a few exceptions, and there are some, the indirect costs are variable costs. So if the work doesn't happen, the cost won't happen. Now, that's not true for things like occupancy. If you sign a lease, that rent's going to happen every month, whether you have people to fill up the space or not. So be conservative with that. I wouldn't go too far out with those leases. But the costs that are variable, be aggressive with those things. If you have a customer that does promulgate a model like DCAA or NIH or NASA, use it. Now, if it doesn't fit, of course, that doesn't make sense. But common sense advice is don't reinvent the wheel. Here's a good idea. If you've got a friend in another company or a customer, I'm not asking you to go get proprietary information from them, not the numbers that go in the pools or the bases, just the structure. Get them to give you a copy. Get a proven model that has been through an audit and they know works. And again, get help with the first one or two you do. Now, the whole idea of indirect rates is you use them to price things out. You track them as you go through the year, and eventually you get an actual rate at the end of the year when you have actual cost for all your pools and you have actual cost for all of your direct costs, your bases. And then you do the math and you look at yourself and you go, oops, because it never comes out exactly like you thought it would. Now, things like fringe cost are really easy to estimate. If you're off more than 0.1% or so, I'd be surprised because those are almost pure variable cost. If you have the labor, you're going to have the cost. If you don't, you won't. Overhead gets a little trickier, and GNA is the trickiest one of them all. But eventually, those costs get put into what's called an incurred cost proposal. And that incurred cost proposal gets submitted to the contracting officer. Now, the question, of course, is who is that? I have lots of contracting officers. If you're a DoD contractor, DoD has an organization called DCMA, the Defense Contract Management Agency, and there is an administrative contracting officer at that agency that is responsible for administering contracts for your company. The relationship between ACOs, the administrative contracting officers, and companies is 1-to-1. You should not have 5 different ACOs. Now, really big companies do have multiple ACOs, but your typical small or mid-sized defense contractor has one ACO that's responsible for administering all of their DoD contracts. I said DoD. The problem is that in the civilian agencies, there is nothing like DCMA. There is no centralized administration organization. So each agency, NASA, CMS, NIH, education, agriculture, justice, every one of them has their own administration procedures. They have their own administration groups within the agency. Some of them don't even have an administration group. It's handled by the individual contracting officers. So the procuring contracting officer, or PCO, retains the administration. But sooner or later, you have to make that incurred cost proposal to the government that says, here's all my actuals for fiscal 2017, and here are the rates that I've calculated. So these should be my final rates. And if you have cost type contracts, you'll need to do a true up to the final rates. If they're T&M, you don't do a true up on the labor, but you might have to adjust the GNA that you've charged on things like expense reports and stuff a little bit up or a little bit down, depending on how the final rates came out. The problem is they don't just take what you give them. You do your incurred cost proposal and they audit it, and then there is supposed to be a negotiation with the government. And the FAR says you're not supposed to have to negotiate with 10 different agencies or 20 different contracting officers. There's supposed to be one lead agency, and it's supposed to be the agency that you do the most of your business with that negotiates your final rates, and all the other agencies are supposed to use the rates that they negotiate. Sometimes that works better than others, but that's how it's supposed to work. By the way, everybody thinks, first of all, that there are a number of misconceptions here. First, they think that every incurred cost proposal has to be audited. You notice the last bullet on the slide there. Audit of the incurred cost proposal is not a requirement of the FAR. There is nothing in the FAR that says that thing has to be audited. In fact, you could submit it to the contracting officer. The contracting officer could look at it and go, looks good to me. You're done. Now, I'm still waiting for that to happen in my career. It hasn't happened yet, but it could. There are actually companies out there right now, we'll talk about this when we get to the trends, that have had that experience with DCAA in the last couple of years. DCAA picked a couple years that were a little bit overaged to begin with, should have been audited several years ago. They looked at them and went, you know what? The last one we audited was pretty good. This one looks about the same. We're just going to go with it. And the ACO sends a letter out that says, we've decided to accept your final rates as proposed. Boy, talk about dodging a bullet. I like that one. As far as incurred cost proposals are concerned, you can't go wrong using the audit program and the template that's provided by DCAA and the information for contractors. All the instructions about doing it are posted at dcaa.mil. And even if you're negotiating with a civilian agency, the basic process should be the same. You can't go very far wrong with it. I suggest taking a look at the websites for both these organizations, dcaa.mil and dcma.mil, if you have any questions about incurred cost proposals. And then if you need to translate it a little bit to a civilian agency for a different contracting officer, it's not a difficult process. Due dates. Now, everybody that doesn't know the due date for the incurred cost proposal, raise your hand. I can't see your hands, but I don't need to. I know nobody put their hand up. Everybody knows what the due date is. It's 6 months after your accounting year ends, right? So if you're on a calendar year, it's 30 June. If you're on the government's fiscal year, it's March 31st. That's when it's due. Here's the interesting thing about that incurred cost proposal. The due date is toothless. If you miss the deadline, nothing happens for a while. If you miss it by a week and you finally get it in, nothing happens. Nothing's ever going to happen. If you miss it by 3 months, you might get a letter from your ACO, if the ACO is really on top of stuff, that says, hey, you haven't done your incurred cost proposal. Where is it? At the 6-month mark, you'll probably get a letter that says, hey, this thing's past due, get it in here. At the 1-year mark, a year late, you'll probably get a letter. If you're a defense contractor, it'll come from DCAA, maybe, might come from your ACO, that says, hey, you're a year overdue with your incurred cost proposal. If you don't get it in, we're just going to unilaterally determine your rates. And they will do that in another year. I'm not suggesting that the deadline isn't real or that it's not important, but it isn't one of those, if you miss the deadline, something really bad happens. It's not. It's a target. It's an important target, but that's what it is. The fact is DCAA gets, and we're talking just about DoD now, but DCAA gets more than 3,000 incurred cost proposals every year. They're eventually going to have to examine. Notice I didn't use the word audited. It says audited on the slide, but they're going to have to examine those incurred cost proposals and make a decision about what to do with them. Some of them will get audited. Some of them will just get a pass, and you'll get a letter from the ACO that says, looks good. Some of them will sit in the drawer for a couple years. That's pretty typical, by the way. And then you'll get a letter that says, we've looked at your last 3 and they look pretty good. Or we're going to audit them all at once, things like that. The DCMA handbook, if you're a defense contractor, says that if you're a major contractor, and a major contractor is one with $100 million or more of auditable dollar volume. Auditable dollar volume is cost on cost type contract and the cost reimbursable portion of any other contracts, like the non-labor portion of a T&M. So that's a pretty good sized contractor, $100 million of ADV. If you're in that category, your final rate determination should be done by 27 months after submission of your proposal. So 6 months and 27, that's what, 33? Yeah, I can do that math in my head. A little less than 3 years. It's 36 months for non-major contractors, so that's 3.5 years. DCAA for a long time was way, way behind auditing incurred cost proposals and settling final rates. Congress got in the act, really cracked down on them, and now DCAA claims to be current. The reason is that Congress put a provision in the National Defense Authorization Act about 3 years ago, that said DCAA is forbidden to do work for any civilian agencies until they get current with all their incurred cost submissions. Well, DCAA was billing the civilian agencies for somewhere between 40 and 50 million a year for services performed for the agencies, and that revenue just went away. They didn't have any way to pay for some of their auditors. So they needed to get current and they needed to do it quickly. So they looked at a lot of small incurred cost proposals, especially those that were way overdue, and they just cleared them. They sent out letters that said, hey, these rates look good, consider them final, send us a final bill. Now that created a problem for DCMA because DCMA needed to close the contracts once the rates were final, and they got way behind closing out contracts, and they're still working on that. So they're closing contracts. DCAA now, in order to stay current, because they only cleared about 2,000 last year and they got 3,000 new ones. So they're building a little backlog again. In order to stay current, they're going to have to clear more incurred cost proposals than they get every year, which means that some of us are going to get a pass again. We're going to get that treasured letter that says, hey, we looked at your incurred cost proposal and it looks pretty good to us. You're good to go. But some of us get audited. When we do, these are the most common findings. First, DCAA looks at it and says, is this submission adequate or not? If you use their ICE model, that's incurred cost electronic. It's really just a fancy spreadsheet. It might be missing schedules. There might be some contract briefs that aren't complete. That used to be called an optional schedule. It's considered a supplemental schedule now. And they want it along with the incurred cost proposal. You technically don't have to submit it along with the proposal. You can submit it at time of audit, but it's not a good idea. Once it gets time to audit, it could be because there's missing documentation or something inadequate, or maybe executive comp is a problem, or bonuses and incentives the last couple of years have been issues with a lot of incurred cost proposals. As I said a few minutes ago, ACOs are really under pressure to establish final rates and close the old contracts. The estimate is 40,000 completed contracts need to be closed out. And this is our last poll. What are your biggest challenges in finalizing incurred cost audits, if you have any? Is it issues? Is it contracting officer delays? Is it your own management's understanding of the process or what's going on? Is it lack of resources on your part to support that audit, or is it the auditors themselves holding up the works? Kate, we're going to rush them a little bit on this one because I'm running a little bit behind.
Great. We'll give everybody 5 more seconds to get their answers in. Perfect. I'm going to go ahead and close the poll. And it looks like we have a few more answers this time. Biggest challenges, it looks like just about 30% contracting officer delays, 14% management understanding, about 30% lack of resources, and 30% auditor delays. Nothing under issue resolution.
Good. That's a good thing. I'm just going to briefly talk about a couple trends in the rates area. There is a distinct trend these days toward multiple fringe rates, especially to distinguish between full benefit employees and partial benefit employees. As I showed in my example earlier, we are seeing companies now with 3 or even 4 rates sometimes, especially if they have Service Contract Act contracts. They will sometimes isolate those employees to their own division or fringe pool. Despite that trend, we are seeing people consolidating pools to make the pools larger. It's something, every small company goes through it. The first time they split their pools and have multiple pools, they find out they're too small. And some of those companies end up putting them back together. We've also seen fringe pools based on geography because we're seeing considerable variability in healthcare cost. Sometimes it's also driven by cost of living factors, but more often it's healthcare. Piece of advice, before you split your fringe pools up into multiple pools, consult a good labor law attorney or firm just to make sure that you're not running into a demographic problem and accidentally discriminating on a group. In the overhead area, we're seeing gradations in the pools based on cost beyond just host site, company site. Geography is the most popular. Some of them are broader factors. For example, I ran into a company just the other day that had 6 pools, and it was strict by customer. They had an Army pool, an Air Force pool, a Navy pool, a civilian agency pool, and I think a NASA. NASA is technically a civilian agency too, but they had their own pool. There's a distinct trend away from including fringe in the overhead base. And this is because a couple of fairly high profile issues that came up last year or the year before with some larger companies that had multiple fringe rates and multiple overheads. And what they discovered was that with fringe in the overhead base, it was distorting the allocation of overhead. And there were a couple adverse ASBCA cases. That's the Armed Services Board of Contract Appeals that went against the contractors. And it actually it wasn't an adverse thing. They just had to go back and restate a couple years worth of rates. If you've ever had to do that, that's a lot of work you don't want to do if you don't have to. Take a look at it if you find yourself in that situation. We'd love to hear from you. And before we completely lose contact, I think my compatriot Colin Harris would like to talk to you a little bit and extend an invitation to you to one of our events.
Hi, thanks, Rich. I hope everybody's getting a lot out of this. You guys might have seen me or met me at some of the PNDC events here around Portland or up in Washington. I just wanted to throw a quick invite out to everybody who's attending that might be interested. We're hosting a couple of lunch and learns coming up the second week of October. On the 11th or on the 10th, we'll be in Portland at the McCormick and Schmick's down Harborside in Portland. It's at 11 o'clock. If you're a project-based organization and any of this interests you and you'd be interested in our software and meeting a few of us and getting a free lunch out of it, we'd love to have you join us. And then likewise, we'll be in Seattle on the 11th at the Columbia Tower, Magnolia Room on 5th Avenue from 11 to 1:30 p.m. You can sign up for both of those on our website, or if you want to get in touch with me and have me sign you up, just reach out to Kate and she can make the introduction.
Wonderful. Thank you so much, Colin. Really appreciate that. I will let everybody know we will follow up after this webinar. We will include a recording of this presentation. I know that might be valuable for you to share with your colleagues. We also have a copy of the slide deck and a couple of the white papers that Uninet was nice enough to share with us. Do respond to that email if you want an introduction to Colin, and we can definitely do that and sign you up for one of those upcoming events in either Seattle or Portland. Perfect. I know we're a little bit over time, so I thank you, Rich, for including your email up there. If anybody has any additional questions, or I know Colin is here in the Pacific Northwest as well, we'd be happy to help you out. We will conclude today's webinar. Just a reminder of a few upcoming PNDC events. This next Wednesday, October 3rd, we will have our EAR and our ITAR compliance conference. And then PNDC's annual dinner will be November 13th. We are welcoming the Chief Technologist for NASA, as well as the Commander of the Navy Region Northwest. Thank you, Rich and Colin. We really appreciate you sharing this very valuable information with all of us here today. And thank you, everyone, for joining us. That does conclude our webinar today.